Interest rates and the Fed go together like peanut butter and jelly. You can discuss one without the other, but together they create a classic partnership that can sometimes get messy. What does the Federal Reserve do, and why do we care? Foster Motley's Thom Guidi and Sarah Browne will tackle those questions and more. I'm Patrice Sikora. First, Thom and Sarah, thanks for being here. It's good to see you.
Thanks, Patrice.
Great to see you.
All right, now, Thom, why don't you start us off with an overview of the Fed? Why does it exist, and what is its dual mandate?
Great question and a great starting point, Patrice. So there's two tools to regulate economic activity over time for the federal government. There's fiscal tools and there's monetary tools. So fiscal tools are the realm of Congress and the federal government. It's taxation and spending. We know that's a very political process. It's going to vary significantly over time. And then there's monetary policy. So, monetary policy is the realm of the Fed, the Federal Reserve. And monetary policy governs interest rates. And those interest rates, if they're lower, there can be more economic activity. Uh, if they're higher, potentially less. But the interest rates also are a good tool to control inflation over time. So the Federal Reserve has a dual mandate. They're trying to balance economic activity, especially as it relates to employment and inflation. And most recently, we've been very focused on inflation because we had inflation pop up for the first time in a long time. So since 2012 or so, we've had a inflation mandate that we're trying to reach 2% inflation. Yeah, I remember that the old target was 3%, and then it went down to 2.5. And ever since about 2012, they've tried to target 2% inflation.
All right, let's take that discussion on inflation a little bit further. Sarah, talk to me about the FOMC.
So the FOMC, the Federal Open Market Committee, are a consist of the Federal Reserve board members and the regional bank presidents. Basically, it's their job to set the policy and change the interest rates at about 6-week intervals when they meet.
And are there any political implications here?
And that's a great question right now. So they would tell you no. And that's a really important part to distinguish the FOMC from other branches or super governmental agencies of the federal government. They're completely independent politically from anything in the government. It's this independent system within the government. And many chairs have actually served under different political regimes under their same, sentence, so to speak. I think this is a great time to pull up a direct quote from our current chair, uh, Jerome Powell, in his last press conference that, with the upcoming election, he was asked this question, and I just want to pull this quote. It sums it up very well. He said, quote, "We never use our tools to support or oppose a politician, political party, or political outcome," end quote. And I think that just sums it up pretty well. So though no, they are not a political, they are independent, politically independent.
Now, you mentioned the same chair has served under different administrations in the White House, different party administrations. How long is the term that the chairman has?
So it's a 4-year term. They're nominated by the president and then confirmed by the Senate.
And Powell he was actually added to the committee by Obama, correct?
Yep, that's correct. Added by Barack and then elevated to chairman by Donald Trump and then reconfirmed renominated by Joe Biden. So 3 different presidencies, different political agendas from the politicians and all the same chairman.
Okay, and as Thom mentioned, the FOMC meets about every 6 weeks. They've got another meeting coming up. The last time around, we kind of thought we would get a cut, and we did not. What do we see coming up, or do we at all?
Yeah, so that's another great question. The next meeting, like you said, coming up September 18th, right now the market is pricing in a 100% chance of a 1/4 of a percentage point cut.
Now, Tom, you're smiling and laughing. What are you thinking?
Yeah, there's never a 100% chance. The the market might price it that way, but we don't know.
Right.
But it's also important to remember they're not restricted to moving in quarter percentage increments. When they need to act quickly, they can move faster. In fact, when they were raising interest rates back in 2023 predominantly, it was in three-quarter% increments were the biggest moves. So we know the FOMC, the Fed, can move very quickly when needed.
In your experience, has the quick move been up or down?
It can be either. Most recently, we're fighting inflation, so the interest rate move was up. And so that was a quick move up where I think we had four different three-quarter% moves. Is that right, Sarah?
Yep. In a row, 4.
During COVID, interest rates were moved down fairly rapidly. And then thinking back to, say, the financial crisis started in
Mhm.
2007, and it was very acutely about, the Fed's realm. Interest rates and banks were all kind of wrapped up in it. They moved interest rates down very rapidly at that point. So it depends on what the Fed is actually trying to fight, and it depends which direction they're going to move, and um, the environment determines how quickly they have to move.
Explain to me the Fed funds rate. Whoever wants to do that, take it. Go for it.
Sure. I could do that. That's that's my directly correlated with what I do and love to do. So the Fed funds rate is a short-term interest rate that the Fed uses to control monetary policy. As Tom alluded to before, if we increase the Fed funds rate, it's known as tightening monetary policy. In other words, maybe pulling back on economic activity if things are getting too hot, if inflation is too hot, or they can lower it in times of distress, economic distress, when we need to give consumers and other lenders a little bit of a breather. So that's the main mechanism that the Fed uses for its policy.
It's important to remember what it's not. It's not people's mortgage rate. Uh, I know that gets a lot of focus. Now, directionally, if interest rates rise in the short run, something like the Fed funds rate, it could impact mortgage rates, especially over time. It's not CD rates at the bank, but um, it's really this short-term lending that goes on is the Fed funds rate.
But it does impact the direction of things like mortgage rates and CD rates.
Most likely, yes. But you have to remember that short-term rates right now are actually higher than the longer-term rates, like mortgage rates. So the market is already assuming that interest rates will fall at some point from here by setting those longer-term rates lower than the short-term rates.
And you talk about the market. When the Fed did not cut at its last meeting, all the doom and gloom sayers were, "Oh, the market's gonna collapse here. It's just go they're not nobody's gonna be happy." Well, it didn't. Talk to me about that.
Yeah, I mean, the economy remains very strong. Consumers in light of what we could take I mean, in my opinion, we could take it all the way back to the financial crisis. There's been a lot of savings since then when we were really the economy was really, really hurt. So I think over that time, consumers built up a bunch of savings, and then with COVID, we actually got some influx of capital. People are consumers are a lot stronger than economists and market participants have anticipated, and it's seen time and time again in the economic data that's released.
Tom, any further thoughts?
Yeah, I think it's very hard for the Fed to hit the right number to control what they want to control because the results of them increasing or decreasing interest rates can take a while to filter through the economy. So, what the Fed has done is they raised interest rates to a higher than where we have been recently, north of 5% level, but then they kept them there for a while. So, the interest rate plateaued. And so, by holding it there for a longer period of time, than maybe what the market was anticipating. They're using extended period of time at those higher rates to control inflation. Uh, it has not caused a big economic meltdown of any
Mhm.
sort. Probably the biggest results were some weaker financial institutions failing. But on the other side of the coin, inflation has come under much better control than where we were just a few years ago. Now, remember, inflation being under control doesn't mean prices drop. It just means that they stop rising. So we still do
Mhm.
have higher prices than we do 2, 3 years ago.
Sarah, does this bode well for a quote unquote soft landing?
Yeah, I don't know that we will get a soft landing when all is said and done, but right now, what it looks to be is that inflation has come down as the Fed chair wants it to, and that we haven't seen a huge collapse in economic activity or hiring or labor market economics. So, I mean, it's looking that way, but the end of the book hasn't quite been written yet. So more on that soon.
True, true, true. Well, we kind of touched a little bit on it, but what happens to financial markets when the Fed does actually reduce rates?
Yeah, so instantly you're gonna see money market rates, decline in tandem with the Fed funds rate. As far as bonds are concerned, I can't say exactly what they will do, but I can give you an idea based on past easing cycles. And that's basically that rates are going to come down, which is obvious at the front, but all rates are going to come down. And then you're going to get on the yield curve what's called a steepening of the yield curve. And basically, that's short rates come down more than long rates. So maybe all the rates are coming down, but the short term interest rates are falling at a faster pace than the long term interest rates typically. And Tom, you're more of an equity professional expert than I am. What do you think about the equity markets to that end?
So lower interest rates are generally supportive of economic activity. So that would be a positive for the stock market. It's going to be a little bit different for each industry. There's a lot of other extenuating circumstances. So it's not a kind of one to one relationship, just interest rates. That's not the only determining factor for if next year is going to be a good year for the stock market, but it certainly would support it.
Well, what are some things or steps that uh, clients, investors should consider, should think about in light of the Fed possibly lowering rates?
Yeah, I think first off, we've had this experience the last couple of years where savings rates, things like money market rates or high yield savings accounts, have paid higher rates than we had been used to. Uh, if you are still in a situation where you have money in a low interest rate checking account, it's still worth keeping money set aside for short term needs in something like a money market or higher yielding savings account. So you should evaluate what type of interest rate you're receiving. But you should also evaluate whether you have too much in something like that, a money market or a high yield savings account. Because if you're thinking, well, right now I'm getting 5%, well, that's going to go away rather quickly if interest
Mm.
rates start to come down. But at the same time, you're saying, well, I'm keeping this set aside because it looks so good. Uh, Eventually, I want to put it in maybe a balanced portfolio of stocks or bonds, other longer term investments. Well, if you wait until interest rates have already dropped to take that action, you might be too late. So it might be buying in at higher prices. So I would evaluate now whether you have too much set aside in the emergency fund.
Hmm. All right. Sarah, any additional thoughts on that?
I think he covered it well.
Oh, very good. Well, then, how can folks reach you at Foster and Motley if they want to discuss this further?
So they can go to our website, www.fosterandmotley.com. That's the best place.
All right, fantastic. All right, folks, the Fed's actions can impact your portfolio, and the people at Foster and Motley can help you understand your options. For more about life and wealth topics, be sure to follow this podcast so you know when a new show is ready for you, and please share with others. Thanks for being with us.